Market update from IG Melbourne. Once again, the August sort of trading that we're seeing in the US continues to be the case overnight. It's very, very shaky. It's also very, very low in volume. It is obviously the height of summer and most traders over in the US are on holidays. But in saying that, it is certainly all about taper talk, and it's almost becoming a sort of a capital letter in terms of where it's operating itself. And we're starting to see almost like tin soldiers lining up from Fed presidents with regards to when, not if, when taper will actually start. We've seen Charles Evans, Sandra Pilanto, we've seen Richard Fisher, all basically suggesting that the data is now lining up, that yes, there is monetary tapering opportunities coming up probably in September to October. In saying that, we have actually seen two that are not suggesting September, more likely October. Dennis Lockhart came out the night before and said, look, the uneven performance of the economic data suggests that we may need to sort of resist any sort of calls to going early. And then last night, Jamie Bullard was out there. He has been quite dovish for a very, very long time, and we do understand that. And how much weight he has is a little bit debatable. But he certainly came out and said something quite interesting. He believes that the macro performance still isn't completely completed yet. It's a little bit incomplete, same as what Dennis Lockhart said, but he did also say that he believes there should be a press conference attached to the October meeting. Now, that would suggest if they're going to do a press conference attached to that meeting, they're more looking at an October date rather than a September date. And that's something that we've been suggesting for a while. We think at the September 16-17 meeting, you may actually see more wording, more sort of data in terms of language coming to the market, rather than tapering, preparing the market completely for the idea that it's only monetary taper. It's not going to be anything to do with rates. They're probably going to downgrade their views on GDP, inflation, etc., to make sure rate expectations remain quite low. All of this is probably what's causing a little bit of shaky market trading on the equity side. They are obviously at all-time highs with the S&P, but in saying that, it's all about just a little bit of weakness there and just that little bit of uncertainty that is keeping investors probably away from the equity markets. And you can also see that in the dollar. The dollar is still remaining quite strong considering, and that's because we've seen some pretty good data. And tonight we will see a lot more. Unemployment claims are out tonight in the US, CPI data. You've also got some manufacturing data and industrial production across the region. So that's all another reason maybe to sort of ramp up taper talk and hearing about it. Watch the US dollar. It does look like it's going up, and that's going to be the continued theme, not just now, but over the next couple of weeks. What was also pleasing last night was actually to see the Europeans coming out of recession. It is only just, and we probably need to sort of take this as one grain of salt before we see Q3 and Q4 for this year. But the French obviously snapped out of recession for Q2, up 0.5% after being down for the last two corresponding quarters. We also see the Germans getting stronger again at 0.7. They were relatively good the month before, but also it's the peripheral countries. Portugal's GDP finally snapped out of 10 consecutive quarters of loss. They're up around about 1.1. It means that there is a little bit more stabilisation over there. And from probably more a regional move into Asia, the advantage that this has with Europe now getting itself back in line, back on its feet, is that it does have a very, very high consumption of industrial metals, particularly things like copper and aluminium. It's why you've seen on London Metals Exchange, it's now at around about $7,275 US a ton, and over in London, in New York, over on the CME, it's currently trading at about $3.37 a pound. All moving in the right direction. That's very good news for places like China. It's also good for South Africa, also Brazil, and more importantly here in Australia, where we do have around about 66% of the market with regards to those industrial metals. It is a good thing on that perspective. It may obviously mean that we see that material space continuing to punch higher on the ASX today. It's the one area that we do see a lot of rotation into. That is understandable. There is profit taking coming on at the moment. We are in the middle of corporate season, and corporate season has seen on the defensive sides particularly a sell the fact idea. Yesterday CBA's result was very, very headlining with regards to record profits and record earning takings. It did look quite strong. However, they do see things being still quite conservative. They're still slightly concerned by the underlying economy, and from a market perspective, the payout ratio was too low. Even at 75.4%, most probably wanted 78 to 80%, and the full-year dividend of $3.64 is slightly lower than what some people wanted, where they wanted it up from around about $3.70, and the final payout of $2.12 to $2.15, rather than the $2 that they actually got. That all was the price to perfection. It's why we saw it came back. It's the same story with CSL. CSL had a 19% jump in profit, but again, slight weakness in the European and also the US division because of the warmer winter meant the flu vaccination wasn't picked up as strong as it probably could have been. Their immunoglobulin side also was a little bit weaker. And again, that's their two major drivers. And that's why, considering it was also priced to perfection at $64.50, that it's come back off around about 3%. And also has the FX headwinds, as it still has hedge overlays from probably around the start of the year. Moving to the Australian market today, having a look, again, gets back to earnings season. We're looking for AMP. We're also looking for Wesfarmers. Wesfarmers is a really good overlay with regards to how the underlying sort of staple community is going. Watch your Coles, like-for-like sales expected up around about 4.5%, year-on-year up around about 5.9%. Looking for a full year net profit of roughly around about $2.1 billion. Now, if they can get that, it means it's probably beating Woolworths in terms of where it's sitting. It also means that the EPS are around about $2.30, and that is also a fairly good beat. In saying that, it is trading around about $41, $42. That does again look quite expensive, and it may be another sell fact idea.